So here's our jelly roll. As you can see, I'm long the call spread, short the put spread. I could have just sold out the call spread, couldn't I? I could have sold my July 65 call, and I could have bought back the June. I can do that. When I do that, I'm selling the call time spread, the one I'm long. Closes me out. Or I could sell the put spread. Now, which one do I want to do? Well, I don't know. Let me take the value of the call spread, and let me take the value of the put spread and see which one's trading higher. Because I want to get out at a higher price as a seller than what I got in at as a buyer. Remember that old adage, buy low, sell high? That's what we're doing here. Since we have two alternative ways out, we definitely want to take a look at which one is more expensive, because as a seller, I want to sell high. It only takes us a minute to check this out. Now let's take a look at the other jelly roll, the other side of things. Instead of being long the call spread to start off with, let's be short the call spread. Let's be long the June 65 call and short the July 65 call. We can see that this is a short call spread because we're short the out month. We're not long it. And we're long the front month, not short it. So we've got a short call spread on. We could always take it off the conventional way, simply by buying the call spread back. Buy the July 65 call back, sell out your June 65 call, we'd be out. But we have an alternative way of getting out. We could not just buy back the call spread, we could, if we wanted to, buy the put spread instead. Why would we do that? Because if the put spread is priced lower than the corresponding call spread, after adjusted for cost of carry, interest and dividend, then this is going to be the cheaper way out. We're going to make more money. A lot? No, a little bit. But it's still more than we would have by buying the put spread and getting out, closing into the jelly roll, as opposed to just simply getting out of our call spread in the conventional manner. We've got to take a look at this. Now look at what we have here. You're going to notice the value of the jelly roll will be the same. Even though in the front month, we're now what? Long call, short put. Now we're long stock in the front month. Short synthetic stock in the out month. What does this mean? Long stock, short stock, we have arbitraged ourselves out of this. We are now in the jelly roll. We have a position with no position. But that doesn't mean it doesn't have value. What's the difference between the interest of the first month and the interest of the second month? Well, we said the front month was 6 cents. That remains. The second month is 16 cents. That remains. So what's the value of the jelly roll? It's still 10 cents. Regardless of how we get in it, we got a June position and a July position. What separates the two? Time. Time moves equally the way it always does. It doesn't, we don't have like the one day where there's only 12 hours. We know that whatever the value of this jelly roll is, whether we're short synthetic stock in the front month and long it in the second month, or long it in the first month, short in the second month, we know the value is the same. This jelly roll is worth 10 cents. This time, we're long in the front month, short in the second month. When June expires, our long synthetic stock will become real long stock. Real long stock versus synthetic short stock is what? It's the conversion. At June expiration, this jelly roll, unlike the other one which became a reversal, this jelly roll turns into a conversion. Long real stock, long the put, short the call. Our jelly roll goes from a jelly roll to a conversion when we're synthetic long stock in the front month. Why does this turn into real long stock? Well, we're looking at the stock strike of 65, right? Stock closes above 65. Our 65 call that we're long finishes in the money. We're going to exercise that. giving us the right to buy stock. When we exercise our long June 65 call, we're going to obtain a long stock position. If the stock were to close below 65, we are short the June 65 put. That means whoever is long that put will see that with the stock below 65, they have a put that they own that has real intrinsic value. What are they going to do? They are going to exercise, which means you get assigned, which means you must take delivery of the stock that they're allowed to sell, making you long stock. So either way, wherever the stock closes, we're going to have a real long stock position. Depending on the jelly roll, whether you're long synthetic stock in the front month or short the synthetic stock in the front month, the jelly roll will transform itself at front month expiration into either a conversion if you're long synthetic stock in that front month, or a reversal if you happen to be short synthetic stock in the front month. Again, here we are, and we're long the put spread. We could easily sell out the put spread. We could say, hey, I'm going to sell out my July 65 puts, and I'm going to buy back my June 65 puts. I'm out of my put spread. But we know that we could also sell the call spread. When are we going to just sell the put spread outright? When it's more expensive than this corresponding call spread. If the call spread's more expensive, then let's sell the call spread. If the put spread's more expensive, sell the put spread. On the way in, we want to buy the cheaper one, after adjusted for cost of carry, interest and dividend. On the way out, we always want to sell the more expensive one. Buy low, sell high. Works right here. We now have an advantage of doing the cheaper one on the way in, the more expensive one on the way out. If we get an opportunity to do that, then we're going to make extra money. If they're in equilibrium, do whichever one you want. So basically, how the time spread works is really completely about time decay. The front month option that we're short decaying at a faster rate than the out month option we're long. And why is this? We know that theta decay is nonlinear. The quicker we get to expiration, the closer we get, the quicker the decay of the option. Our front month option always decays faster than the out month. And as that happens, when we're spread, we're short this one and we're long this one, what happens is that as this one loses value faster, what do we see? We see an expansion of the spread. That's us making our money in the long time spread. We're making money not so much that something is gaining value over the other. In our premium collection time spread, we're making money because our short option is losing faster than our long option. Now, to understand, although delta neutral here, we do have a gamma position. As the stock moves away from the strike of our long time spread in either direction, up or down, as the stock moves away from our strike of the time spread, we will start losing money. The spread will decrease. Why? Well, take a look at your sheets. Take a look at a time spread that's directly at the money. Take a look at the June-July 65 time spread with the stock priced right at 65.50. That's close enough to the at the money. And look at the value of that time spread. Now what I want you to do is go take a look at the June-July 50 with the stock at 65.50. See, the 50 strikes are both in the money. They're both 100 delta. They're both mimicking the stock identically, and both have zero extrinsic value. The value of the spread is zero. Now take a look at the other side of the spectrum. Go take a look at the June-July 80 spread with the stock at 65.50. Well, both of those calls are pretty much worthless. If there's any value at all, it's very small, 10 cents maybe. So we notice that the at-the-money time spread is bigger with the stock directly at the money than it is if the stock moved down to 50 and we still have the 65 time spread on, or up to 80. The time spread for you people that are going to be using it as premium collection, the long time spread, has its most value when the stock is directly at the money. Stock moves in or out in either direction, it loses value. Now, when do we look to use this time spread? Really, we have to really focus in on a consolidation, preferably a tighter consolidation. We need the stock for at least the month that we're short the front month option, we need that stock to be trading sideways. The time spread is good for premium collection in a short amount of time. We don't have to have this position on for a very long time, but we need the stock to stay still. Remember, our time spreads Greeks, the long time spread included a short gamma position. That means with the stock moving in either direction, it will be adverse to the profitability of our position. We also know that although I do not suggest trying this at this point, a short time spread can be viewed basically as the cheap man straddle. When that big, fat, at-the-money, month of earnings straddle is trading at a ridiculous price where it's too expensive for you to purchase, do understand you might get away under certain conditions you need to learn about first. Under certain conditions, you might be able to sell the time spread. Because remember, when you sell the time spread, it makes you money as the stock moves away from the strike in either direction. Remember, the value of the time spread is highest directly at the money. If I sell the time spread, then I want to see the value of that spread decrease. Where does that happen? Well, in the example we just looked at on your sheets, it happened up toward 50 from the 65 strike, up toward 80 or down toward 50. As long as we can move that stock away from the strike, our time spread will decrease in value. If it decreases in value and we're short it, we'll make money. Now, unlike the long straddle has an unlimited potential profit with the stock moving up, unlimited with the stock moving down. Our time spread, our short time spread, won't. Because it's a limited gain, limited loss position, no matter where the stock moves away from the at the money, we can only make so much. But that might be better than nothing when trying to trade in earnings where you feel the stock is going to move somewhat dramatically away from where it is now. We might be able to take advantage of selling a time spread in that situation instead of actually buying that front month fat straddle, which even if the stock moves, quite often the break-evens were too wide and it collapses on us. We'll talk about that in a bit. We can also use it to trade some type of weird skew in the volatility tilt. Remember, we're involving two separate months here in the time spread. And if we buy one month, sell the other, we have the ability to sell a month where we have a vol tilt that's skewed where that month is too high in comparison to the others. Or we might be able to buy a month that's cheaper compared to the others along the lines of an average tilt. Remember, before you do something like that, and this still might be a couple years away, before you do something like that, remember you have to have a model or a way of calculating the average tilt. You probably don't have that now. But why am I telling you this now if you can't take advantage of it? To understand that there's going to be a time you can. And if you know this exists, and you know that at some point in time, with the right model, you're going to be able to actually calculate the average tilt, then you'll be ahead of the game because you'll know that whatever has an average, especially when we're talking about volatility, which is mean reversive, It has to come back in line at some point. This is how we trade volatility. Now, we know that we're looking for a premium collection opportunity, a point in time where the stock is not going to move. And that charting pattern is called a consolidation. And let's take a look at ways that we can determine where and when a consolidation is going to happen. Well, I'm back.
Yes, I can see that. Good job. You did an excellent job up there.
Thank you.
Time has passed since I last saw you, which means that somebody out there is making money in the time spread.
That is exactly right. They're collecting premium as time passes, just like they would with a time spread.
All right. Well, the key here is to stack the odds in your favor. And since 80% of the time a stock is going to trade sideways, pretty much you could throw a dart at a board, and most of the time you're going to hit a stock that is trading sideways.
Right.
What you want to do, though, is you want to stack the odds in your favor, and you want to stack as many odds as possible and identify high probability outcomes and not just throw the dart at the board. So
you also want to try to make sure that you get in at the beginning of that consolidation.
True, good point.
You'll get some better prices. So that means that timing is going to be very critical. And when we talk about timing, not only identifying movement by identifying the timing of that movement, we got to throw it over to you for some technical analysis.
All right, so basically what I'm going to show you is I'm going to show you after a stock has just made a big move, which is the best time to initiate your time spread after it just made a big move and you think it's going to consolidate. The key is to identify that early in the game. So I'm going to show you exactly how to do that right now. You ready?
I'm set.
Put on your seatbelt.
I got it strapped on.
All right, bye. So what we're talking about now is a time spread, which is ideal for a consolidation when a stock is moving fast and then all of a sudden it just consolidates. I'm going to show you one where you saw a lot of clues and a lot of red flags that was just about to happen. But basically what you're doing is you're going to sell the front month option, which decays very rapidly, and you're going to buy the second or third month option. Let's take a quick look. Okay, here you have Chevron, CVX. Now, I see, just from looking at this, a number of clues that jump out at me that tell me that this is about to happen. First thing that we do is we find all the key price points that we can. We look at all the support and resistance. You can see there was a little bit of a channel here. What you want to try to identify is the channel, and you want to take advantage of the stock trading in a tight range. This is a little bit volatile, and you can see that the market and probably the options market is used to bigger volatility. Here you can see the volatility declines, trades in a tight range. You can see that this is a major price point right here. You can see the market rallied after getting slammed. You can remember the market basically traded down about 40%. Chevron rallied off of about 55, made it up to about $70, 77 right here where it closed. Once it broke through that level that it couldn't break through right here, it became the new support level and kind of acted as a new support level a couple more times. Now you can see that this, I drew a red line over the past resistance and new support levels. So obviously 70 is a key price point. Now the market was a little bit hectic, obviously. I don't know if anybody remembers that small correction we had in 2008. But the market sold off 40-some odd percent. Chevron's one of the major S&P companies. And you can see that we had huge, huge swings of 20% in a day, 15% in a day, which is pretty unusual. But at that point, it was the norm. You can see after the market started to calm down a little bit, you can see it's not as erratic as it was over here. And then this found its support. At the same time, we have lower highs, which is a descending triangle. That descending triangle was broken. So you expect that when Chevron, as soon as this happens, I don't care where Chevron goes, bottomed out around $55, $57 a share. Chevron can go to 2, and then years later rally back up. I'm going to look at this $70 price point. So when this is happening, I'm just expecting that whenever this decides to turn around and come back up, it's going to find resistance right around here. So the market kind of found a bottom. The S&P, NASDAQ, Dow, they all found a bottom right around mid and early March. Now this is one of the key players, Chevron. It has a big impact on what happens to the S&P. So what you want to do is you want to try to find as many clues as you can so you find other price points. You can see at one point Chevron dipped below this support level, found some support here. And keep in mind, once it dipped below this support level, I would have looked for some resistance right here. That didn't happen, but that's what you would do as a trader. You would look for some resistance once the support level was broken. But it ripped right back up, bounced, and made lower highs. This is a key level, though. You have to keep that in mind, and you can see that it kind of stalled after selling off. The market was deciding whether or not it was going to slice right through this point or whether it was going to remain a support level, sliced right through. And you can see that once that happened, it kind of fell like somebody pulled the floor out from under it. It sold off to this point that we established back in October. So it's important to always take key resistance and key support levels. And remember, old support becomes new resistance and vice versa. You can see March, this is where we bottomed out. Now, after bottoming out, we expect that after such crazy selling and crazy buying, it's not normal to have 15% price swings in this stock every single day for a couple of months. But we expect that the volatility is going to shrink. You expect that the trading range is going to become more narrow, so that's going to give us an opportunity with our time spreads. So we decide when that's going to happen. You can see that we already have these two key price levels right here that kind of coincide with what we found to happen right here. We already know that this is a key level, and you can see that it acted as support quite a few times. This key level that used to be support and then was violated acted as the new resistance several times. So that's the key to identifying a consolidation pattern. One other thing that you want to look at, and I mentioned this several times in the past, is the volume. Now, when a stock is consolidating, that means the sellers stopped selling and the buyers stopped buying. And they're kind of at a stalemate waiting to see who makes the next move. The buyers don't want to buy and run the stock too high. The sellers think this is about a fair price. So if everybody agrees that it's a fair price, why is it going to move up or down? You could tell that everybody kind of agrees that this is a fair price because it landed somewhere in the middle of this major range that we have here. At the same time, volume dried up. It's almost the same exact amount of volume every single day. We have about the same number of green bars as we have red bars, and they're just about the same height. So volume consolidated. We have a big move up off the March lows. You can see we have a MACD sell signal right here. We have low volume. We already have these key price points established well before we take our position and make our time spread happen right here. So anywhere around the earlier stages of this consolidation point, when you see the volume drop, you see the range becomes a much tighter range, you want to get in kind of early when the options are still priced to the old volatility. So what you're going to do is you're going to short the front month, and you're going to buy the out months, 2 or 3 months out. And that's how you do your time spread.
To see how Ron selects options that match Chris's strategy, visit the members section at optionsgps.com.
Hey, that was an excellent job. I mean, I really like how you keep it, real simple. I mean, so many people try to overcomplicate things when they don't need to, and I think that, one of the things that's great about you is you keep it simple. I mean, you just, here it is, I'm looking at this, 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 and this, and when these all come together, bang, here I am.
Ron, that's one of the most important things. When it comes to technical analysis, I just want to tell the students that, there are thousands of different indicators and, tricks and, everything.
Oscillators.
There's too many of them, and what you're going to do is you're going to confuse yourself or you're going to, too many conflicting signals. What you want to do when it comes to technical analysis is you want to nail down a couple of indicators that are highly accurate, and historically proven. And you want to stick to just those indicators and, as you say, keep it simple. Because when you start to get, too involved in learning all the different indicators, you're really missing the big picture. You're missing the forest for the trees.
Paralysis by analysis.
Paralysis by analysis. It's the first time I ever heard that one. So basically what you want to do is you want to keep it simple, as Ron said, when it comes to technical analysis. There are a lot of other things that I saw on the chart that I did not really point out because I don't want to get too deep into it.
And you don't need to.
Yeah. Well, check out the Internal Strength System study course if you want to learn more about technical analysis. But now we're going to talk about rolling and morphing, the time spreads that you just learned about. Now, just like everything else that we're talking about when we get into rolling and morphing, same thing applies here. As the stock moves or time or volatility, what's going to happen is all the different variables that go into the price of the option tend to change. And you could still make money if you just sit in the same position a lot of the times, but often, there's a lot better that you can do by rolling and morphing and basically readjusting your position so that it fits with what the current circumstances are.
Exactly. I mean, whether you're in the right position or not to start off with, at some point in time, that position will no longer be valid. And we have to know ahead of time where it's not going to be valid and then what we're going to do when it becomes not valid.
Well, sometimes to stay in the same position after a while, it could just get boring. You just want to change.
Well, let's not change for that reason.
Okay.
You know, I'd rather be bored and making money in the right position than to sit there and change it into something that doesn't make money.
Okay, so you're mixing making money with changing the right position, and that's exactly what we want to do right now. And go to it. Show us how you can roll and morph our time spread.
You got it. Now that we've identified the charting pattern we need to see when we want to take advantage of a time spread, that consolidation, let's start taking a look at what we do next. Now it's time for us to set up our trade. The first thing we're going to do is we're going to sell a front month option that's at the money and buy a farther out month option that's of the same strike but different month, obviously. So we might sell the June 65 and buy the July 65 or the December 65, something further out. That sets up a long time spread. Now, if by chance we were looking at the short time spread in front of an earnings, that's when we said we would do that, we would do it a little differently. We'd buy the front month and then we'd sell the at month. But remember, that's rare indeed. It's not going to happen often that we're short a time spread, potentially in front of earnings. And earnings only happen 4 times a year for each stock. So the one we're really focusing on is the long time spread, selling the front month at the money, buying the out month at the money. Let's take a look at our long time spread. For instance, say if we buy one October 90 call for $7. And then we sell the front month, which happens to be September, the front month September 90 call for $4. We want the stock to stay at 90 right through September. If at September expiration we have a stock that is still at 90, we will have maxed out the value of our spread. If we were short the time spread, flipping the whole situation around here, instead of selling the Sep 90 call, we would buy that front month September 90 call. And we would sell the out month October 90 call. Here, obviously, with the short time spread, we're receiving a credit, where with the long time spread, it was actually a debit trade. Once we're in the short time spread, we want the stock to move as far away from 90 as possible in either direction. At that point in time, we would see a maximization of the profitability of our trade. So what are the keys to success in the time spread? Well, again, it comes down to understanding, or at least having a better idea of where the stock is most likely going and how quick it might get there. In this case, we want to find an opportunity where the stock isn't moving. If we stumble across a chart where it's looking like obvious consolidation, then the time spread would definitely be a trade we'd look at. We've got to understand that premium collection has everything to do with extrinsic value. If we see a consolidation movement that we feel strong enough about that we're going to buy a time spread, knowing that this is about extrinsic value, then it's obvious which options we're going to be using. We are going to be using the at-the-money options. We can't take advantage of decay in an option that has no extrinsic value. So we're not going to be going deep in the money. We're not going to be going far out of the money. To truly take advantage of the time spread, we need to use the at-the-money options where the true extrinsic value lies. We also need to remember that buying the call spread is the same thing as selling its corresponding put spread. That means we have the ability to get in and out of our time spread in more than one way. We have alternatives. We have choices. That means what we need to do is find the most cost-effective one for what we're trying to do. And finally, theta is the key word here. We are actually trying to neutralize stock movement as much as possible. We're really focusing in on theta and trying to take advantage of our decay. Know thy Greeks. Now that we've got our time spread on, and hopefully the stock is doing what we want it to do, let's see how we're going to adjust the position as things start to change. What if the stock goes down? Well, we know that when we're in the long time spread and the stock goes down, it's not doing what we want it to do. If the stock starts moving in either direction, we are in the wrong position. We're going to be losing money, and that is not the goal. So in terms of rolls, we're not going to be looking at any. We don't like to continue a losing position. The stock is not consolidating now. It is now either trading up or trading down. Either way, we must make a change. So if the stock starts trading down, we have a couple choices. If we're in the call time spread, we're going to want to change our position into a synthetic put. Obviously, with the stock going down, a synthetic put would probably be a good strategy for that situation. If we were in the put spread, we're going to want to change our put spread into a short stock replacement. Obviously, a much better position than a put time spread if the stock starts to trade down. Again, we're in a situation where the position we have on is no longer optimal due to the fact that the stock is now changed in terms of its status. It's no longer consolidating, it's now moving. It could be moving down. We can always close out. If we're not feeling it, it's not working right, we are not in sync with the chart, and we're now unsure, we can always close out. Here we are in our long call time spread. As you can see, we're in two options of the same strike, 65. And we are long the out month and short the front month. This is our typical premium collection construction. It's a debit trade. Think about that for a second. Remember what I said earlier? Not all credit trades are premium collectors. And I said that there's a lot of instructors out there that kind of give the idea that if you're in a credit spread and you do a credit, then it's premium collection. If you do a debit, it's premium outlay. Incorrect. Here's a perfect example of a normal strategy that is a delta neutral premium collection trade that's actually a debit spread. This spread's a debit. We pay to do this trade, but it is first and foremost and almost exclusively a premium collection trade. Perfect example of the fact that just because it's credit doesn't mean it's premium collection, and just because it's a debit doesn't mean it's not premium collection. Well, let's see what happens here. We're in our long call time spread. Maybe we've been in it for a while. Maybe we're already up money, but suddenly the stock starts to trade down. Well, when I look at my position here, I'm really not in a position to take advantage of a downward movement in the stock. And if the stock moves enough down, I would be probably looking at a situation where I'm going to start looking at a maximum loss scenario, which we don't want to see. So what am I going to do? Well, which option is really hurting me here? If the stock starts going down, am I being hurt by my short call, or am I being hurt by my long call? If you said your long call is hurting you with the stock going down, you're right. But we have a problem. We can't just take the long call out of the picture. We can't just sell it out, because that would leave us naked short an option, this front month short call. And we know that's a no-no. So we've got to do something else. If we go back and remember our lesson on synthetics, that is going to give us a clue as to what we can do. What we're going to do to morph this to change it into a synthetic put is to simply add the purchase of a put. We're going to buy the front month at the money put, the one that's corresponding to our short call. When we do that, we no longer have a real option position in the June 65s. Short call, long put equals short stock. We now have a short stock position here. We're short stock, long a call. What does that equal? Short stock, long call. There is your long synthetic put. Now with the stock trading down, we're no longer in our time spread. In one simple trade, the purchase of our short call's corresponding option, the put, we turn this call into a put. We are now in a synthetic July 65 put, and we're long it. So with the stock going down, we're in good shape. We can now start making money with the stock going in a direction that we hadn't anticipated originally. We can morph our trade, our time spread, and start making money on the downside. What if we're in the put spread? Obviously, we have a little bit of a different story here. Because if we're in the put spread and the stock starts to trade down, it's the short put that's creating difficulty. Our long put would be working for us. Here, if we get rid of our short put, we're in fine shape because we're not left with a short option. We're left with a long option, which is fine. So what do? If we are in our put time spread and the stock starts to trade down, we simply buy back this short front month put, leaving us in a July 65 put, long that second or third or wherever out month option you bought. That now functions like a stock replacement put. Short stock to be exact, right? Long put replaces short stock. Now with the stock trading down, our long put is in a perfect position to make us money. And what are we going to do with it as the stock trades down? We're going to roll it. We're going to roll it as the stock's trading down. What you've got to realize is that when you morph whatever position you're in, whatever strategy you're in, into another strategy, you've got to get the old strategy out of your head. It's gone now. There's a new strategy here. And you need to be comfortable enough to really be able to understand that and trade it accordingly. Now we've got a roll we have to think about. So if we're in a long put spread and the stock starts going down, simply buy back that front month put and play the next month put long in a short stock replacement fashion. Now, we can always close. We can always close. If we were long our call time spread, long the July 65 call, short the June 60 call, we know we could just get out conventionally, sell out our July 65 call, buy back our June 65 call. We know we can do that. That's easy. But remembering that this put spread can also take us out, we need to check the put spread also. We could sell a call spread to get rid of our long call spread, but we could also sell the corresponding put spread. If we did, this is what it would look like. We're selling the July 65 put, buying the June 65 put. This creates a short synthetic stock price or stock position in the front month, a long synthetic stock position in the second month, short stock, long stock, no stock. The position is shut down. Now, what if the stock starts to go up? Here I am in my long time spread, and the stock starts trading up. What can I do? Well, obviously, I do have a long time spread here. I'm long the July 65 call, short the June 65 call. This long time spread happens to be a call time spread. And now the stock is trading up. Now that the stock is trading up, we have to ask ourselves, which of these options is hurting me? In this case, with the stock trading up, it's our short call that's hurting us. The short call is giving us the fits. Well, if we got rid of that short call, we simply have a long call left. And that works. We can do that. And that long call would then track the stock up as it was trading up. We buy back our short call, leaving a long call all by its lonesome. We can do that. And then what happens? We're going to be rolling it. What happens if we're long the put time spread and the same situation happens? The stock trades up. Well, the problem is here, it's this long put that's hurting us with the stock trading up. This is the one that's damaging us. But we can't sell this out because if we did, we'd leave a short naked option on the board by its lonesome. That's unacceptable. Too much risk. We've got to do something else. What can we do? Think about what we did for the call time spread when this situation happened, when the stock started moving in a downward direction. We went to that front month short option and bought its corresponding option. Here, we're going to our short put in the June 65s, and we're buying the corresponding call. When we do that, look what we've set up. A long call, short put position in the June 65 strike. Corresponding options. Long call, short put, 1-to-1. That's a long synthetic stock position. Thank God we studied our Greeks. Now that I'm long stock plus long put equals a long call. With the stock trading up, I've turned my long put time spread into a protective put strategy. And now I can take advantage of the stock trading up instead of having the stock move away from my strike and losing money in my time spread. Now, what happens with our long call time spread here? We could always shut it down. Whenever we're wrong, don't be afraid of just simply shutting down. There's no problem. If we're long, we can always shut down. What did we shut down here? Easy. Long call time spread. We could either sell the call time spread or we could sell the put time spread. Whichever one is more expensive, cost efficiency. That's what we're talking about. We want the optimal one for getting out. When we're closing a long position by selling, we want to sell the one that's higher. And the jelly roll tells us which one. Okay, now what happens if we're in the long put time spread and the stock stays still? Obviously, this is exactly what we want. If we're in a long time spread, we definitely want the stock to stay still. But there is something that we could be doing. See, we've only assumed that we sold the front month and bought the second month, like we did the last time. Here, with the put spread also, what if we didn't buy the second month and we had bought the 5th month or the 8th month? What happens if we had originally set it up where we bought October and sold June, and the position is working and everything is okay? What can we do come June expiration? Well, if we think this consolidation is going to continue, we can simply do this. Roll out to the July option. And now we have the October-July time spread. And when July comes front month, we know August will come on. When July expires, we can roll out to August. And then later rolling out to September. If we think it's a longer-term consolidation, we're not forced to buy the second month. We could have bought something much further out and just simply rolled out month after month after month until we got up to the month that we're long in. We would collect a lot more premium that way, but we have to make sure we're looking at a longer-term consolidation. Remember, we can't go rolling month to month unless it's working out for us and we feel that the trend, which was now sideways, this consolidation, is going to continue for another month. So we do have that roll available to us. So that about sums up what we have here with the time spread. Do understand that the time spread is predominantly a premium collection trade. And I don't even want to say predominantly. It's all about premium collection. It's delta neutral, which means we don't really have to worry too much about the normal fluctuations of the stock. But do understand, if the stock starts to rock and roll to the upside or to the downside, away from our at-the-money option, then we are going to be looking at maximum loss scenario. But the nice thing is, because we as investors, at least 97% of the time when using the time spread, are buyers trying to do the premium collection style trade, we don't have to be super concerned about what that loss might be, because we know when we buy options, we can only lose what we spent. So if we're looking for an inexpensive, delta-neutral premium collector to take advantage of consolidations that we find, the time spread, the long time spread, is probably the strategy we're going to look at.
All right, Ron, you did a pretty good job on that one. I give you 1.5 thumbs up on that one. All right, well, we covered the time spread now. You can make money when stocks go up and down, and now you know when they go sideways, you can make money too. And the next thing you're going to cover in the next DVD is the diagonal spread. You have diagonal calls and diagonal put spreads, and we're going to check out both of them. So before you do that, go to the community at optionsgps.com, talk to your peers, take the quiz, and pass the quiz. Remember, there's a glossary there if you need to check up on any terms or any words. And I'll see you when you pop that DVD in. Diagonal spreads. See you there.
Let's take a look at what we could do with Chris's example of a consolidation in CVX Chevron. We don't really have an opinion to the direction of the stock. We think it's going to go sideways. What can we do? The time spread. And how are we going to set up this time spread? Very easy. We're going to be buyers of the out month, sellers of the front month. And since this is a premium collection strategy, a strategy in which we are going to try to capture decaying extrinsic value, which strike do you think we're going to do this in? That's right, the at-the-money. We are going to look at the at-the-money options. First, we're going to look at April. That's the option that we're going to short. But we can't do that one first, can we? We can't do our April short option first because that would leave us naked short in the market. That's a no-no. So we bump out to June. Our first move is to buy the June at-the-money call. With the stock at 64.71, the June 65 calls are going to be at the money. And we're going to pay $5.20 for them. Then, now that we have our long on, and we're not going to be caught naked short in the market, we can now sell our April 65 calls for $2.85. What we're going to take advantage of is the spread between these options expanding as the front month loses value more quickly than our out month. We're short the front month, we're long the out month, and we hope that we have a stock that's just going to stay right where it is, right near the strike, and really let the decay of that front month option make us money. We can also do this in the puts. We already know that we're going to be looking at the same thing. Buying the June 65 put, selling the April 65 put. Why would we do the put spread over the call spread? Take a look at your jelly rolls. Your jelly roll is going to determine which one is more cost effective. If they are in line, then hey, do whichever one that you like the best.